So I appreciate you guys coming in and tuning in today. For those of you who don't know me, my name is Cayman Menard, and I'm the most recent advisor to join the team here at Somnio Wealth. And I just wanted to preface and say that this webinar today is meant to be practical and calming. And today is going to be all about forming perspective, not necessarily about making predictions. So we're going to spend some time on the current market backdrop, and then we're going to focus on something that matters just as much, how investors can think clearly and stay grounded when markets are feeling very volatile. So before we get into all of the details in here, I just wanted to say a few housekeeping things. Just as a reminder, you can email questions during this presentation to my email up on the screen right there. We're going to have a dedicated Q&A session at the end of the presentation. So like I was saying earlier, thank you guys for joining. And this is designed to be practical and calming. We're here to provide perspective, not to make bold predictions about what's going to happen next. The bigger question isn't what the market's going to do next week. It's how to make good decisions when that environment can feel uncertain. So we're going to go over the current market landscape and environment, and then we're going to try to help think clearly about which things going on actually deserve your attention. Then we've got a few calls to action depending on your situation. So, like I said earlier, we're not trying to predict the next 6 months. We're just trying to frame the current environment. So, as we're all aware, markets have felt more like uncertain and noisy than they have in the past. And we just wanted to remind you guys that volatility is normal, even when it feels uncomfortable, and that headlines can make short-term moves feel way bigger than they are. And just because there is a lot of uncertainty, that does not automatically mean there's a call to action or we're required to do something. So while the headlines change constantly, the bigger question is not what the market's going to do next week. It's how to make good decisions when the environment feels uncertain. So before we get into the main planning takeaways, I wanted to quickly frame the market backdrop that we're dealing with right now. So the main point is going to be this environment is a mixed environment. It's not broken. There's still positives in the market, but there are several things investors are watching very closely right now. To kick off with inflation, CPI rose 4.2% year over year in May, and a big part of that recent increase came from energy prices, which matters because energy can flow through to other parts of the economy pretty quickly. So things like transportation, business costs, and eventually even consumer spending. And that's going to tie directly into the Federal Reserve policy right now. So in June, the Fed held rates steady, and inflation is still above their long-term target. So even though investors would like more clarity on when rates may move lower, the Fed is still being very, very cautious. And we got to talk about the 10-year Treasury too. So this is super important because it can influence a lot of our financial system right now. And this is not something you need to track day to day or even week to week or month to month. But it is one of those key rates that investors are watching out for because this rate can show up in a lot of different places. It can influence things like borrowing costs, mortgage rates, bond prices, and how investors actually value stocks. So speaking of stocks, the market leadership lately has been fairly concentrated in just a few large companies, especially those connected to AI, and they've carried a lot of the market's momentum lately. Now, that does not mean the AI theme is wrong, but it does mean investors are watching whether all the spending on things like chips, data centers, power, and infrastructure can eventually turn into real earnings growth. So the takeaway is this: the backdrop is mixed, not broken. There are reasons to be constructive, but there are also reasons to stay very disciplined. And this is a part of life. Headlines are going to keep coming, rates are going to move around, Fed expectations are going to shift, inflation reports are going to keep coming out, and elections and policy decisions are going to create uncertainty. And the news cycle is always going to find something new to focus on and try to grab your attention. And usually this thing is negative. But I think one of the important questions is not just what happened in the market today or what's been happening recently. I think a better question is, does this actually change anything about my personal financial plan? So, for example, a Fed headline may move markets in the short term, but it may not change your retirement timeline. An inflation report may be important context, but it may not mean you need to abandon your long-term investment strategy. And geopolitical uncertainty can always feel uncomfortable, but uncertainty has existed in almost every single market cycle. So the goal today is not to ignore the news. That's not what we're telling you. The goal today is to put the news in its proper place in your life. So with that, we're going to look at four practical areas that investors should prioritize right now, regardless of what the market's going to do day to day. So the first thing investors should focus on is their own personal goals, not the headlines. Now, this sounds simple, but it's one of the most important ideas in investing and in planning. The market does not know when you want to retire, when you want to buy a house, when you need income, or whether you're saving for college, a major purchase, or just long-term financial independence. That's why short-term noise should not outweigh your actual goals and your timeline. So, for example, if you're still 15 or 20 years away from retirement, volatility may still feel very uncomfortable for you, but it may not change the long-term purpose of that money. But also, on the other hand, if you need cash in the next year or two, that money should probably be treated differently than long-term growth dollars. So when markets feel uncertain, the better question is not just what do you think the market's going to do next, but the actual better questions are, when do I want work to become optional? What am I saving for? Is it retirement, a home, college, or a more specific goal? You need to think about what kind of income or cash flow you're going to need from your portfolio. And once we have those answers, we can start making better decisions. Some dollars may need to be protected. Some dollars may need to be invested for longer term growth. And some dollars may need to be positioned for income or be flexible. That's why the plan matters. The headline of the day, it may create emotion, but your goals should drive the actual decision. And once we're clear on the goals and the timeline, the next step is going to be to focus on the things that you can actually control. Because we can't control market headlines or interest rates, short-term volatility, but there's still several important areas where investors do have control. And the first thing you have control over is your savings rate and your habits. So how much you set aside and how consistently you do that, that can matter a lot over time. Markets get most of the attention, but investor behavior and consistency are often what keeps the plan moving forward. And that rolls right into your spending discipline. So this does not mean to never spend money. It just means to make sure your lifestyle, cash flow, and your long-term goals are all working together instead of competing against each other. And we also want to talk about diversification. So the goal is not to avoid every single down period in the market because frankly, that's just impossible. But the goal is to avoid having too much of your financial future depend on one company or one sector, one investment theme, or one specific outcome. And when you want to think about diversification, you also want to think about your risk level. So your portfolio should match your goals, your timeline, and your comfort level. If the portfolio is too aggressive, volatility can become emotionally difficult. And if it's too conservative, it may not give the plan enough growth. The right answer depends on the person and the plan. And fifth is going to be rebalancing. Over time, portfolios can drift. Some areas may grow faster, some areas lag behind, and eventually the portfolio may look very different than you initially intended. So rebalancing helps bring the portfolio back in line with the actual strategy. And finally, your tax positioning. This is where we want to think about after-tax results, not just your investment returns on paper. Being aware of your marginal tax bracket and what can trigger a taxable event can help you make informed and aware decisions. If you're unaware of your personal tax situation, this is one of my personal favorite things about partnering with Somnio CPAs, actually, because here you can receive tax advice from your tax preparer, and you can look at your taxes through the lens of how it actually affects your investments and your whole picture year over year. So the point of this slide is simple. When the market feels uncertain, focusing on what we cannot control usually creates anxiety. Focusing on what we can control gives us better decision-making framework. And once we focus on what we can actually control in our lives, the next big piece of this is going to be your behavior. Because even if you have a well-built plan, that can still be very hurt by emotional decisions that you can make during a volatile market. So when we talk about this is where investing becomes less about spreadsheets and numbers and more about your actual decision making. So when markets are calm, most investors can feel very disciplined. But when the market gets volatile, emotions tend to get way louder. Things like fear, urgency, and overconfidence can all show up very quickly. Fear might make someone want to sell just because the market is down. And urgency might make someone feel like they need to do something immediately. And overconfidence can show up in the opposite direction. So when someone wants to make a big tactical move just because they know exactly what's going to happen next, or they think they know exactly what's going to happen next. And this is the issue with volatility because it can amplify all three of these things at once. And that's why discipline and preparation are going to matter so much. A plan gives us something to come back to before making a major decision. It helps us ask the better questions. Like, has your timeline changed? Have my cash needs changed? Has my risk tolerance changed? Or am I simply reacting to the discomfort of this particular moment? And also, not every single uncomfortable market environment is going to require something like a portfolio change necessarily. Sometimes action is required, but sometimes it's a better decision just to pause, review the plan, and avoid letting short-term emotion drive a long-term decision. One of the phrases I love here is urgency is not the same thing as a strategy. So your goal should be not to ignore volatility. The goal is to avoid letting volatility make the decision for us. And the fourth area is going to be planning opportunities that can exist in something like a volatile market. So up to this point, we've talked a lot about not reacting emotionally to volatility, but that does not mean investors should ignore what is happening or never make any changes. There's a key difference in reacting and reviewing. Volatility is not just something to survive. It can also be a good time to review whether your plan, portfolio, and your tax picture are all still aligned. So one of the first opportunities that can arise is going to be in your allocation. So if markets have moved significantly, your portfolio may look very different than it did before. Some areas may have grown faster than others. Other areas may have pulled back way more than others. And it's worth asking whether your current mix still matches your goals, your timeline, and your risk level. And the second area is going to be your cash needs. So if you have money that you may need in the next 12 to 24 months, that money is going to be treated differently than the dollars that you have set away for long-term growth. Having just the right amount of liquidity can help prevent you from being forced to sell your investments at the absolute wrong time. And once again, we wanted to highlight the importance of tax positioning, especially during volatile markets. It can create unique opportunities to volatility, like tax loss harvesting, Roth conversion windows, or distribution planning decisions. And they're not always available in the same way when the markets are calm. So it's worth reviewing when the conditions do change. And the last area, and this one's going to be unique to this slide, but it's going to be protection planning. So a strong financial plan is not just about your investments or your cash flow. It also needs to account for any type of risk that could interrupt your plan. So that can mean other things, like protecting yourself from risks outside of the market as well. Things like health coverage, disability coverage, the proper insurance for your family, or having estate documents in place. And this all depends on what stage of life you're in at this moment. So the goal is really to make sure the plan is protected from all sides. So whether it's a market risk, an income risk, a health issue, or even a complicated family situation, one unexpected event should not derail your entire big picture. So even though we want to talk about planning opportunities that exist during volatility, the message is not that volatility always means you need to make a change. It's more like volatility can create moments where you want to review intentionally. And we don't want to react just because the market is uncomfortable, but we also don't want to miss opportunities to improve the plan where they become available. So to bring this all together, the question becomes, what should investors actually be focusing on right now? So we turn this into a simple checklist for you guys that you can ask yourself. So the first question is going to be, has my long-term plan actually changed? And this one's going to be the anchor question because a lot of the headlines feel urgent in the moment, but not every headline is going to change your retirement timeline, your income needs, your savings goals, or your family's financial priorities. If the plan has not changed, then the portfolio decision may not need to change either. And the second question is my portfolio still aligned with my goals, timeline, and risk level? So this is where we connect your investments back into the plan. The right portfolio is not just about what did well recently in the market. It should reflect when you need the money, how much volatility you can reasonably handle, and what the money is meant to accomplish. And the third question is going to be, do I have enough liquidity for short-term needs? And I think this is one of the most practical ways to reduce stress during volatile markets. If near-term cash needs are protected, investors are way less likely to be forced into sometimes emotional decisions. So that liquidity can give long-term portions of the portfolio a better chance of staying invested, even through something like an uncomfortable period. And our last question here is going to be, are there planning opportunities or areas that I should be reviewing? And this is where volatility can become constructive. It may actually be time to review something like your rebalancing, tax loss harvesting, specific opportunities within your personal tax bracket, your cash needs, or whether your overall strategy still fits. The point is never to make changes just because markets are noisy. The point is to review intentionally. So if there's one framework to take away, it's this. Don't start with the headline, start with your plan. If the plan has changed, we review the strategy. If your portfolio is drifted, we review the allocation. If cash needs are coming up, we protect your liquidity. And if the market creates tax planning opportunities, we review and look at those carefully. And that's how we move from reacting emotionally to making thoughtful decisions. So, to wrap this up, the main message is that volatility often creates way more noise than it does clarity. When markets are moving quickly, it's easy to feel like every single headline you see needs a response. But most of the time, the better approach is going to be to just step back and ask whether anything has actually changed about your plan. Has your timeline changed? Have your goals changed? Have your income needs changed? Has your risk tolerance changed? Or is the market simply uncomfortable right now? So that's why we keep coming back to the same idea. Stay anchored to your goals, your plan, and the decisions you can actually control within your life. And that does not mean ignoring what's happening in the market. It just means putting market events in the proper context. Some headlines are going to matter, and we're not acting like they don't. Some are going to create risks, some are going to create opportunities, but they should be filtered through the plan before they become decisions. So if you're wondering whether your portfolio still fits, whether you have enough cash set aside, whether your risk level is appropriate, or whether there are planning opportunities worth reviewing, we'd be happy to talk to you about it personally. And our goal is never to predict every single market move. Like we said earlier, that's frankly impossible. But the goal is to make thoughtful decisions that are connected to your actual life, your actual goals, and your long-term financial plan. Okay, with that, I'm going to pause here and open it up for some questions. And if any of your questions today is more personal to your specific situation, feel free to reach out after the webinar and we can talk through it one-on-one. Let's see here. Okay, we had one person asking. So they said, if I already have a lot of cash or cash in money market funds, should I just still stay there until things are calmed down? So I can understand why that would feel appealing, especially right now when money market and cash is earning way more than it used to be. And cash can absolutely be useful. I'm not saying it can't be. And it can protect things like your short-term spending needs, your emergency fund, or upcoming tax situations. But I would say more of the risk can come from when that becomes your long-term plan just by default. Markets can often start recovering before headlines feel comfortable again. So if you're kind of waiting for like an all clear, you're probably going to end up sitting out of the market way longer than you can think. So I'm not framing cash necessarily as good or bad. I would just separate it by purpose, if that makes sense. That's a good question. Thanks for asking. Someone else asked, how do I avoid making a decision I'm going to regret during a volatile market or when there's a big market drop? It's also a good question. I would say the biggest thing here is just to slow your decision down. Nothing that is going to happen in the headlines or the news is going to force you to make a decision within the next 5 minutes. So before making a major change, especially something like your investments or something that can affect your investments, like a big purchase, I would just ask, what problem are you actually trying to solve by reacting to the news or the headlines? Is this based on an actual like change in your plan, or is it more based off of just discomfort in the moment, or you saw something you didn't like? You also want to think about your own tax consequences if you were to make an emotional decision like that. And what would you need to happen to reverse that decision, if that makes sense? I just think that kind of process can help prevent a temporary market environment that's going on right now from turning into a permanent life mistake. You guys got some good questions going. I appreciate all the interaction and everything. Let's see. Okay, we got another one. So this person asked, with interest rates still elevated, are bonds still useful in your portfolio? That's a good question. I would say yes, in a lot of portfolio, bonds are still going to make a lot of sense. I think one thing you got to understand is just that bonds are not meant to do the same job as something like stocks are. Your stocks are generally for things like long-term growth, and bonds can be there to provide income and diversification, and they're going to be a lot more stable portion of your portfolio than your equity side, especially if you're like retired or even close to retirement or just withdrawing from your investments right now. So also when I say that, the type of bond that's in the portfolio also matters a lot. I mean, we still want to think about things like the credit quality of the bond, the maturity and the duration, and how it's treated in a tax way as well. So in no way do I think like bonds are broken or anything like that. I would say bonds still have a big role, but they need to be structured intentionally around your specific goals, your income needs, your risk level, and your tax picture, if that makes sense. You guys have some good questions. I appreciate it. Okay, I'm gonna hang around for a few more minutes to see if we get any more questions. I appreciate you guys so much for joining and tuning in and listening today. And like we were saying earlier, if you'd like to schedule a meeting with your advisor or feel like there's anything else you want to talk about, not necessarily on the webinar, but maybe face to face or over the phone, feel free to call our office or visit our website or email me right here, whatever you feel comfortable with. And yeah, I appreciate you guys taking the time today. I hope it was educational and useful. All right, I'm not seeing any more questions at the moment. So once again, thank you guys for joining. It's been a pleasure, and hopefully I'll see you guys in the next couple weeks or months with another webinar.